House prices are falling across the country, with prices around £15,000 lower than last summer. After a prolonged boom in house prices, house price inflation is now turning negative, with some of the fastest falls since the last crash in 2008. Adjusted for inflation, real house prices are around 11% lower than last summer. However, there is still some uncertainty about what is actually happening. The latest housing blog from Rightmove is quite bullish, with Rightmove claiming house prices are reaching new record highs. What explains this contradiction of different claims? What is happening right now and what might happen next? Well, the Rightmove figure is somewhat misleading, as their index is a measure of asking prices that appear on their website. But the asking price can be significantly different to the actual agreed selling price. And in recent months, there's been a growing divide between the gap between asking prices and selling prices. And this is actually quite normal during a housing downturn, because homeowners tend to have an inertia and a reluctance to reduce the sale price. If you hear that your house is worth £300,000, there's a real psychological reluctance to list the house below that figure. However, the pressure of rising interest rates and falling real wages is really putting pressure on potential buyers and also increasingly homeowners themselves. Last summer I made my first video about a potential UK house price crash. It was based on the economic fundamentals of a deeply overvalued housing market combined with the shock of rising interest rates after a unique 15-year period of ultra-low rates. Last year, house price to earning ratios reached a record levels, around 9 times average earnings, and the highest level since the 19th century. Since then, these ratios have only very narrowly declined, indicating there may be more pain still to come. It is still higher than at the peak of the last 2009 crash. So since last summer, house prices have steadily fallen by a small amount. But what I didn't predict was Liz Truss's crazy experiment, which sent interest rates soaring towards 6 or 7%. It meant that in theory households could be paying up to 40 to 45% of their income on mortgages, a level not seen since 2007 or 92. It was like a recipe for a big house price crash. The arrival of Rishi Sunak and the reversal of many of Liz Truss's economics brought a degree of stability back to the market. However, interest rates are still significantly higher, and last month's inflation data was very bad news. Despite the headline rate falling from 10% to 8.9%, it really worried markets because the fall was much less than expected, and the inflation figures also showed that underlying core inflation, which ignores all the volatile energy and food prices, was creeping up. It means that the UK's so-called temporary inflation has morphed into a more permanent inflation as workers gain nominal wage rises, although not enough to exceed inflation, it should be added. But it means it's more bad news for the housing market because the hope of a rapid fall in inflation now appears more unlikely. At the start of the year, many forecasters were quite confident inflation would be around 2% by the end of the year. But a persistent pattern of the past 2 years is that inflation forecasts have been consistently wrong in underestimating inflation. This is the Bank of England's forecast compared to what actually happened to inflation. And the Bank of England itself has admitted its inflation model is not working very well. And the result is that mortgage rates have climbed sharply. During COVID, the Bank of England's effective interest rate was around 1.5%. Today it is 4.5%, but with expectations it will rise further, possibly to 5 or even 5.5%. This shows the current fixed rate deals on offer and also the revert to rate, which is what you end up paying if you don't choose a particular deal, and it's an indication of the turmoil in mortgage markets. So first-time buyers face the prospect of significantly higher interest rates than in the past decade. And to understand the magnitude of a change, if we look at, say, 2021, effective interest rates of around 1.5% on a £270,000 mortgage. The mortgage cost was around £900 a month. But 2 years later, in the summer of 2023, this could potentially be in the region of £1,500, an extra £600 a month. Now, of course, not everyone will see this kind of jump. That was quite a large mortgage as an example. and fixed rates are more common than in the last financial crash. But the majority of fixed rate deals are only around 2 years. And so in the next few weeks, over 1 million people will see the end of the very cheap mortgage deals that they got during COVID. And the problem, of course, is not just higher interest rates, but that the UK has experienced an unprecedented decline in real wages, with average incomes struggling to regain pre-COVID levels. A combination of rising energy and food prices have left many struggling to pay bills, and interest rate rises on top of this will be quite a difficult situation for the economy. Now, you can hear reports that the UK economic growth is doing better than expected, but I feel that this is slightly misleading, because what it really means is the UK has avoided the very dismal prospects for a deep recession. But economic growth, although positive, is still very low compared to the previous trend growth. Usually when the economy falls behind, it is easier to catch up the lost output, but that's not happening. UK growth is still very weak, lower than our main competitors, with a very significant amount of lost output. And the very real concern is that interest rate rises on top of this will add to all the current headwinds and push the economy into recession. One particular area of weakness in the housing market is the buy-to-let sector. In recent years, the most attractive element of buy-to-let has been capital growth, with house prices almost doubling since the start of 2009. But now landlords see little, if any, scope for rising prices, and combined with much higher interest rate costs, the profit margins are much less attractive, especially for the amateur buy-to-let investor. So what about the prospects for future house prices? Last year, the OBR predicted a 10% fall in nominal prices with a very slow recovery, and so far this prediction appears on track. Moody's also predict a further 10% fall in nominal prices from today's level. Yet even this would do relatively little to reduce historically high house price to income ratios. Given the jump in interest rates, surely we would expect a more significant drop. Well, that is a possibility, but there are a few factors propping up house prices. So let's see whether they will hold up for much longer. Firstly, demographic factors have increased the number of households, more single people especially, though it is worth mentioning that population growth is starting to be significantly lower than previous forecasts. Secondly, the UK's relatively slow growth in home building, made worse by the high inflation and high cost of building, means that the UK has a relative shortage of housing, at least compared to our European neighbours. Thirdly, when comparing house price to income ratios to the past, these days it's much more common for mortgage applications to have two earners rather than just one. There's more women working than in the so-called golden post-war period. Fourthly, the alternative to buying a house, renting, has become increasingly expensive. The result is that there's still demand for first-time buyers to try all available means to get a house, even if it means things like a 35 or 40-year mortgage term, or borrowing from your parents or using all the savings that you have. And unless rents start falling, many young people will still feel like they're between a rock and a hard place. Expensive rents versus an overvalued housing market. Fifthly, high inflation will also mean that any house price correction will occur partly through the effects of inflation. If we use real house prices, which is adjusted for inflation, the fall will look more dramatic. Now, there are other factors as well, such as inherited wealth, overseas buyers, housing being converted to Airbnb. But I would say that overall, although important, they don't trump the short-term effect of much higher interest rates and the change in market sentiment that is slowly beginning to unravel. Now, a rapid crash in house prices is very unlikely, unless there's some kind of unexpected banking crisis, which sees a 2008-style credit crunch. Usually house price corrections are less dramatic, but take place over a couple of years. The 90s correction lasted for 4 or 5 years. And this is because homeowners slowly adjust to the changing market. There's a lot of inertia in trying to keep those asking prices as high as possible. And of course, to some extent helped by estate agents who want to keep their asking prices high too. Now, my videos from last summer about the potential house price falls hold up pretty well. But last month I made a video, a fixed or variable mortgage, which was particularly badly timed. And I actually put my money where my mouth is. I chose a variable mortgage. But it was particularly badly timed because literally 3 days later, this really bad inflation data came out, which of course changed the likelihood of interest rates to rise. Now, I partly took out a variable mortgage because I want to overpay my mortgage as much as possible. You know, the higher interest rates is a real incentive to try to reduce your mortgage balance. But the decision to take out a variable mortgage looks slightly less clever than it did when I made the video. But 2 years is still a long time, but it does show that economic forecasting can be a tricky figure. By the way, the video is still worth watching because it raises a few interesting points, especially if you're deciding whether to go for a fixed or variable mortgage now. But one thing I would say is that if interest rates were to rise to 5.5% to bring down inflation, how sustainable would that be for the economy? Interest rates have a time lag before they take their full effect. And towards the end of the year, the combination of falling wages, rising interest rates, will cause a perfect storm of negative pressures on the economy. The Chancellor, Jeremy Hunt, interestingly said he would be happy to have a recession to bring inflation down. But if the economy was to enter into recession, especially next year, the likely election year, you would see very strong pressures for interest rates to come down. The Bank of England's own stress tests suggest that if UK rates were to rise to 6%, it would cause greater stress than the last financial crisis and could cause GDP to fall 5% and property prices to fall by 31%. Now, this prediction from the Bank of England in 2022 looks outdated already because the economy has been more resilient to higher rates than they predicted last year. But nevertheless, it does show that interest rates of 5 to 6% would really be very damaging for the economy and cause a substantial correction in the housing market. But I just doubt how long the bank could keep interest rates elevated because people are so used to these ultra low interest rates in the past. If you like this video, check this one out for more detail on the global nature of a housing price downturn and why it varies quite a bit between different countries.